Hi everybody, my name is Conrad. I'll be speaking about a slightly different sector, which is small business finance. My background and the reason I'm here is because I've got my own startup in the area and I've been raising funding for that over the last few months, which have now closed and hopefully will be going live this side of Christmas. Suffice to say that my startup is very much attacking a market that currently does have a huge number of structural barriers, which I'll talk you through. And I'll talk you through my thinking and the business case that I've sold into investors. So I'm talking about small business lending. So this is a substantial market. There's around 500,000 small business loans in the UK. The average value of the loans is approaching £100,000. The average gross profit in the market is around £1 billion. So it's a large market. The average loan is a 4-year loan, so about a quarter of that becomes addressable annually. So it's a very large market if you can get to it. But here is the challenge. If you look at the structure of different lending products to the small business segment, on the right-hand side you have invoice finance and stock finance. These are very open markets. So there's a thriving sector of brokers and a thriving sector of independent providers. And what that means in practical terms is that only about 1 in 5 of those products is sold by the main bank of a small business. At the other extreme is overdrafts, where predictably you can only actually get an overdraft from your main bank. Well, commercial loans and term loans and mortgages, my target segment, is actually at that extreme. So only 1 in 5 loans to small businesses are by anyone but the main bank of a business. And this situation is not ideal. It's not ideal for the small businesses, of course, because they don't have many opportunities to actually go and find what they would consider to be the optimal supplier for them. It's not ideal for the banks as well, because as we're seeing, the first resort is also the last resort, and banks that are turning away small business lending business at the moment are getting very, very bad reputational issues. So what are the drivers behind this? Well, really there's 2 key drivers as to why banks effectively monopolise lending to their small business clients. The first one is a data issue. So the main bank will have control of a lot of the data sources that are crucial to a lending decision. Most importantly, they can see the bank account data, which is the primary basis for a lending decision. The second area is one of relationship. Because they're the first person that the small business will go to when they're seeking a loan, they have a massive advantage in terms of cost of acquisition. They are the go-to person, and nobody else has that issue. So for me to actually enter into this space and try and change this a bit, I have to overcome both of those barriers. So the first one is around data. And really core to my hypothesis and why I'm going into this market now is I believe that there is quite a lot going on that will actually change the landscape from that perspective. So there's a number of tools that have emerged recently that allow you to extract data from, for example, small business accounting software, which was historically very difficult to do. And there's 3 things that have happened just this year that are actually quite transformational for the data segment. So firstly, you've got the 2 dominant accounting software providers in the market who have together about 70% market share, have both actually launched their online versions. And for one of those providers, it's actually now their default offering in the segment. Well, obviously, as you'll know, software as a service is very much built around the assumption that you'll open up APIs, in other words, open up data availability. The second factor is that the government or the tax office has actually implemented mandatory XBRL filings, which is a form of XML. What that means in practical terms is that financial data for small businesses is now tagged in a very structured and disciplined format. There's a data structure and a data availability that wasn't previously there. And probably most importantly, the banks themselves are beginning to open up their APIs so that you can now actually directly access bank account data if you have the right login credentials. Now, this is driven by emerging personal financial management tools and emerging interaction with small business software, but it does actually begin to change the availability of the data landscape. And then secondly, on the relationship side, my belief is that there is an opportunity to open up a new channel into small business lending. And what I'm trying to do is to actually go by the accountants of small businesses. So in simple terms, the first step to that hypothesis is that small businesses at the moment are putting together very poor quality loan requests, unfortunately, sometimes. In other words, they're not presenting themselves in the best way. So some real data points there. Less than 30% of small businesses have a written business plan, so are actually explaining how they intend to pay the money back. Moving on to the second part, the accountants themselves are actually the most trusted source of support and guidance for small businesses, so they're perfectly placed to actually help out. And finally, the accountants themselves want to help out. So market testing with the proposition I'm going to take to them shows that more than half of them would actually want to try it. So at a high level, this is how I'm trying to actually interact with what are very, very large structural barriers at the moment in that market, and why I think it might be changing. Thank you.
Thanks, Conrad. Thank you very much.